Hello, all the CA final AFM students. So this is the day 2 session for the big chapter, which is combining so many areas, which is the chapter called as Forex in simple. So in this connection with regard to the Forex, today's lectures will be the most important and all the dangerous hit list area of this chapter Forex. Complete hit list areas like money market hedging, currency options, currency futures, bankers hedging, understanding the cancellation extensions and early honors, which are extremely frequently tested in exam, and finally the concepts of forex merged with capital budgeting. All these are the areas of analysis that we are going to make in the today's session. Okay. uh, General hedging I will leave it for you. In the first video I have already done that, but this lecture will be all complicated areas. Okay, all complicated areas of forex chapter we are going to see in the today's session. Okay, let us first begin with what are all the concepts we are going to cover now. See there, the areas are money market hedging, currency options, currency futures, bankers hedging, cancellation extensions and early honor, forex with capital budgeting. These are all the segments we are going to cover. First, I will start with money market hedging, expected question for the Jan exams. Okay, I have taken one question from my question banker. Question number 54. Question number 54. This is the question I am going to do. This is the answer for this question. A 6 marks question which already came in exam. Okay, last session I already discussed about this, but some audio problem came. That's why I said I will be uploading it later. We are editing that. Once it is completed, both I will upload. This I will upload first. Okay, so there I already covered, but one more time, 5 minutes I will cover this, and then we are going to do one consolidated question on MMH. Okay, this consolidated question was not tested elsewhere. This came in RTP. Latest one attempt before also this came. Therefore, there is a bright chance that this question can come in the Jan 26 exam. Change in numbers, concept will be same. So I don't wanted to take any kind of risk. I will cover this for you. If you can do this question, that's it. I'm really telling you, you need not do any kind of money market hedging questions after this. Okay. This itself is more than sufficient for the exams, because this covers all the aspects inside money market hedging. They did not leave even a single aspect of MMH in this particular area. Okay, let's cover. Before that, initially to explain what is MMH, I will take one 6 marks question. Okay, let us see this. An exporter is a UK based company. Invoice amount is $350,000. Obviously, when he is in UK, invoice also is happening in pounds, na? Then no problem. As a forex chapter will not come. UK person ki invoice is made in dollar. That's why forex came into picture. Okay. So UK person is an exporter. UK person is a exporter. So therefore there is a receivable. So invoice amount is $350,000. Credit period is 3 months. Exchange rates in London are spot rates given, 3 months forward rate given, rate of interest given. Show how the money market hedge can put into place. Okay, how the money market hedge can be put into place. Next one. So let us now try to understand how to understand the concept of money market hedging and ace in the examination without having any confusion. Okay, see, listen to the first 5 minutes. I'm really telling you, in life again you will not get a doubt on what is money market hedging. At least till examination you will be extremely confident in doing any kind of questions on MMH. Okay, this is a concept building question. Next question, once you do that, that's it. Again you need not do MMH even before exams. It will implant in your mind the entire diagrammatic presentation and approach. Okay, let us begin. See here, 4 boxes I have made it ready, or already I have prepared this. So please see here. Always money market hedging na 4 boxes theory. If you can put the numbers in these 4 boxes properly, your problem is solved. Okay, there is no other confusion arising. Always remember one question. Okay, always remember one point. See here. Whenever money market hedging question is given, na, first, the boxes on the upper side will be the future. Okay, so what is the contract period here? 3 months. Is it today? T0. This is again 3 months. This is again T0. Okay, first point understood. So, today is 3 months. Reasoning everything I will tell you while we are doing the answer together. Okay, so invoice amount $350,000. Receivable or payable? Receivable. So, I am writing here. $350,000. Receivable or payable? Receivable. Today na after 3 months? After 3 months. Answer my question now. We are from which country? UK. We are importing or exporting? Exporting. Receivable or payable? Receivable. Today or in future? Future. Risky or not risky? Very risky. Reason, if the value falls, we will get lower receipt. Example I will tell without touching dollars and pounds. I will take rupee and dollar. I am an exporter. Exported goods to USA. I need to get $1 lakh. Today dollar is 85. Tomorrow dollar became 83. Then I will get 83 lakhs only instead of 85 lakhs. Correct? Then there is an operating loss of 2 lakh for me or not. That loss I don't want it to happen. Therefore, whenever we make an export, we are having fear of depreciation in currency. Whenever we are making import, we are having a fear of appreciation of currency. Therefore, in order to overcome this exposure risk, we are going to manage that exposure risk using a hedging strategy called as a money market hedging strategy. In money market hedging, we are not going to use forward rates. First of all, money market hedging, the forward rates we will never use. Okay, what does it mean? Everything will happen in the today only. All transaction happens at spot. Nothing is going to happen in future. I am repeating my words one more time. In money market hedging, everything happens at spot. Nothing is going to happen in future. We will do everything. And whatever is required, we will take all those actions today. Those actions will react in future. We are not going to do anything in future. Today's actions are going to react in future. So every decision we will take today itself. What will happen in future? We will tell today itself. Everything happens at spot only in case of money market hedging strategy. This is one of the popular risk mitigation strategy. So how they will do? Let us try to understand. See here. First 5 minutes I said, now it starts. Understand the concept first. See, we are an exporter. We exported goods. Invoice is made not in pounds. Invoice is made in dollars. And that too, it will be received not today. It will be received after 3 months. There is a risk of Forex loss. Therefore, what we will do? See, I will ask a question. When you are receiving, sir, I am receiving after 3 months. How much? $350,000. Then you have to convert that into pounds. Yes, sir, I have to convert. At the time, if the value is down, then you will receive lesser pounds or not. Yes, sir, are there problem, sir? Okay. That means what is involved here? Uncertainty is involved. What is involved? Uncertainty is involved. $350,000. When I am selling today, there is one rate with pound. Future it may increase. Future it may decrease. If it increases, very good, I will get more. But if it decreases, I will get less. Fluctuating intention should not be there. Everything should be standardized. Okay, I don't want to take that uncertainty risk. I wanted to remove the uncertainty. Removing uncertainty ki another name is hedging. Okay, what is hedging? Hedging is making uncertain things as certain. So, making certainty of uncertain things is called as hedging strategy. It's called as what strategy? Hedging strategy. In a hedging, do you know what is the beauty? Listen carefully. In a hedging strategy, we will tell today itself what is going to happen in future. Yes, a bhavishyavani ability we will have. We will tell the bhavishyat. Sir, how come it is possible, sir? Sir, I will give you an example. Forward hedging. What is that? Forward hedging means what? We will go to a bank. We will ask the banker, bank, give me one rate. They will tell you 85. Okay, I purchased that forward agreement. Now what you can tell? After 3 months, whatever may be the rate, I will pay only 85. I will pay only 85. From this, what you understood? Today only you have blocked what you are going to do in the future. So you can tell what is going to happen in future. I will pay 85 for each dollar. Answer over. So in future, what is going to happen? Today only we will tell. Other beauty of hedging. Hedging will always makes uncertainty as zero. Makes uncertainty as zero. In this connection, I wanted to share one very good observation on hedging. Do you know what is the beauty of hedging in Forex? Not just Forex, any hedging strategy. Do you know what is the beauty? Portfolio management, we will read two types of risk: systematic, unsystematic. Unsystematic risk means risk that is coming from unsystematic, risk systematic. Unsystematic risk is a risk which coming from the company. We can adjust it, we can manage it, we can reduce it, we can remove it. Something you can do with it. Systematic risk is an uncontrollable risk. It is a risk that comes from the system directly. You cannot do anything. What is uncontrollable? Systematic. Okay. Hedging will control that systematic risk. Hedging control that systematic risk. Forex fluctuation. Forex fluctuation. Okay. Now tell me, Forex will fluctuate. Why it will fluctuate? Yeah. Government policies will affect. Country situation will affect. Are you understanding or not? Country situation will affect. Natural resources, reserves will affect. Okay. War situations in a country will affect. Banking scenario in country will affect. Stock market's performance will affect. Country's IT industry will affect. Country petroleum will affect. Country exports, imports will affect. Thousands of factors will affect the foreign exchange in India for any foreign exchange. From this, what you understand? It is not in our hands. Yeah, economy is taking care of Forex in the entire world. Why dollar price will increase? Why dollar price will decrease means hundreds of factors will affect them. Now tell me, dollar fluctuation is a systematic risk or unsystematic risk? Systematic risk. But hedging, we are controlling that. Other beauty of hedging. Hedging is a strategy where we control which is uncontrollable previously. Understood the point or not? So humans saw that it is possible to control even that. So they made impossible as I am possible. That's the power of human mind. So here the concept of hedging strategy, you should not just like that, okay, hedging na number, you put the number, answer will come. Observation of identity of this particular concept of hedging is important. Na? Hedging is risk mitigation, everyone will know. But what you should understand, here we are controlling which is systematic in nature. So systematic risk is controlled through strategies called as hedging strategy. That we are going to discuss in the today's session. Are you all ready with it or not? Okay. See here. Receivable. Receivable is there. How much? 3,50,000 receivable. When you are receiving after 3 months. Risky, not risky? Very risky. Risky is with the person making the payment. Forex. A person making the payment is a nice person. No default. He will pay. But whether on conversion I will get the same amount or not is a doubt. Oh, so your problem is not with the default risk. Your problem is with the Forex risk. Yes, Forex risk. When risk will not be there? Answer, what risk you have? Uncertainty risk. Yeah. What uncertainty? Today $1 equal to these many pounds. Later $1 can be having lesser pounds. Na? At that time I will receive lesser amount. Oh, your problem is about lower receipt in future. Yes, sir. Yes, that is my problem. Okay. When uncertainty will not be there for you, if I receive today, uncertainty will not be there. Then receive today. How can I receive today? Yeah, invoice is made for 3 months. Why he will pay today? He will not pay today, but you receive today. If you don't pay, how will I receive today? Yeah. Therefore, MMH started. MMH strategy will make you to receive which is to be received in future. Today itself you will receive it. How? Using a variety strategy. Listen carefully from now. See. There is a receivable. How much? 3,50,000. Receivable, payable, receivable. Asset created, liability, asset created. Okay. Now create a counter liability to the same value. To the same value, counter liability. Receivable ki reverse is what? Payable. Payable how much? Same value. 3,50,000. Okay. Is the asset or liability? Liability. Okay. Now you tell me. This is 3 months. This is today. Now you answer my question. Now you answer my question. This is the dollar box. This is the pound box. Whatever you write in this side should all become dollar only. Whatever you write here should all resulted in pounds only. Okay, here pound should not come, here dollar should not come. These two are dollar boxes, these two are pound boxes. Okay, later in exam how to present the answer I will tell you. Once you understand the knack behind this concept, these four boxes, roughly you can present it in exam. Okay, in the last pages, rough work you can do. 1 minute you will complete all these. Using these steps, when you put wrong answer, chance is made it to 0. You will not make any kind of wrong answer. This way is hedging your risk in exam. If you do this way, your risk is hedged completely. Systematic risk will be completely made 0. Okay, this boxes concept, when I introduced it for the first time, I thought how much time it will take. 1.5 minutes it will take for you roughly to put all these boxes and put the numbers. Directly, boxes wise, you need to put the step 1, step 2, step 3, step 4. Step 5, answer will come. Okay, let us start. See, what I said, reasoning I will tell at the last. Okay, so first let us understand the concept. First, we have a receivable of 3,50,000 after 3 months, which is creating an asset. Therefore, now we need to create a payable to the same value, which creates a liability for us. Okay, so now question, sir, you wanted to create a liability. Yes. When you want to create liability, that liability should mature after 3 months. Okay, 3 months to how much? 3,50,000. Therefore, what you need to do to have a payable, you need to deposit money, you need to borrow money, borrow money in dollar. Therefore, question, next point. Borrow in dollar. Okay, borrow in dollar, how much? 3,50,000. Wrong. If you borrow $3,50,000 today, that will become more than 3,50,000 after 3 months. I want exact matching figure here. Okay, so receivable 3,50,000, payable also should be 3,50,000. It should not be more, it should not be less. Therefore, how much I need to borrow today? I need to borrow 3,50,000, less than 3,50,000, less than 3,50,000. How much? That's why this concept came. Present value of exposure. Present value of exposure. Okay. Now apply your mind. We are borrowing in which currency? Dollar. Rates. Deposit to loan. Dollar pound. How much is the dollar rate? 9%. So relevant rate is 9%. See here. Present value equal to future value divided by 1 plus r whole power n. I don't know how much I need to borrow. So future value I know. It should be maturing to $3,50,000 divided by 1 plus r. 3 months cannot 9 into 3 by 12. 2.25 ante 1 plus 0.0225. That equal to $3,50,000 divided by 1.0225. That equal to 3,50,000 divided by 1.0225. $3,42,298. Sorry, not rupees. Low light came dollar. Okay, dollar. Okay, what is this dollar 3,42,298? You will borrow today 3,42,298 today, which will mature to 3,50,000 after 3 months. After 3 months. Okay. Today you borrowed. What you will do with that borrowing amount? You will put it in dustbin. No. Borrowed dollar 3,42,298. Immediately convert at spot into pounds at spot rate. At what rate? Spot rate. Okay. Now, working we will do below the box. So see here, what happened? Let us summarize everything again. I have a receivable of 3,50,000 after 3 months, which is a forex risk exposure is there. Uncertainty in pound to dollar value. When uncertainty will not be there, if something happens today, uncertainty will not be there. Therefore, today only do it. Today I can't do, already I sold, I will receive. Not that. Create a new contract itself where you will borrow present value of your exposure today. Borrow. You will have dollar. Immediately convert. That means you are getting dollar converted into pounds today itself. Though your invoice value of 3,50,000 doesn't come to you, at least 90% of the value you received or not. What we will do with this is a magic. Listen. So 3,40,000 to 298 we received. 3,40,000 to 298 we received by borrowing. Okay, forget about it. Now we have to convert this dollars into pounds. Okay, at what rate? Spot rate. Because you have done everything today. Na T0 box we have written. So convert everything at spot rate. See the question. Spot rate. I will write here. £1 equal to dollar 1.5865 dash 1.5905. Always remember one thing. Those who are already my students, the problem will not come. But others, please listen one rule first. Okay. Whenever forex questions are involved, first look at the per unit currency. Okay. Sir, per unit is pound. Always your quotation understanding should be from per unit point of view. In simple language, what is happening to pounds? What is happening to pounds? That only you need to see. Okay. So now listen carefully. How many dollars we are having? $3,42,298. Okay. We wanted to convert it into what? Pounds. Okay. Now tell me. We are having dollars. We want pounds now. Means what we have to do? We have to give the dollars and buy the pounds. Buy the pound. What is happening to pound only you tell me. We are selling dollar. Pakka. But what is happening to pound? You have to tell. Reason? Pound is in per unit. So tell me what is happening to pound? We are converting dollar into pound. And we are already having dollar. We need not buy again. So what we don't have, we need to buy. What we don't have, we need to convert it into pounds. Now we don't have pounds now. So buy pounds. Bank has to sell pounds. Bank sells at higher rate. Higher rate will be ask rate. So the required quotation will be ask of dollar by pound, which is 1.5905. So 1 pound equal to dollar 1.5905. I am having dollar 3,42,298. How many pounds will I receive? So here conversion value deposit. So we will deposit. How much amount you will deposit? Pounds. Calculate. 342,298 divided by 1.5905. 2,15,214. 2,15,214. This many pounds we will deposit. Okay. Now this deposit will sit silent. Will give a return. Will give a return. See, this 2,15,214 will be having maturity value of deposit. Maturity value of deposit. How much is the maturity value of deposit? Maturity value of deposit will be pounds. 215, 214 into 1 point and 1 plus 0 point, like that we need to see na. This is deposit. Deposit means we need to see deposit. Which country? Pound. 5%. So 1.5 into 3 by 12. 1.25. 1.0125. That equal to pounds. 215, 214 into 1.0125. 217,904. 217,904. Means what? How to understand? For this $3,50,000, at last you received 217,904 pounds. Okay. Now listen carefully. We completed the question. We completed the question. So I wanted to spend around 35 to 45 minutes on money market hedging. First 10 minutes you leave. 15 minutes we completed this question. Exam, this all explanation you need not tell na. You can do it in 6 to 7 minutes we can complete. A speed will come only when you practice. Let us see what is happening in this particular question now. Okay, 217,904. Let us first check the answer. Perfect. 217,904. Okay, decimals you leave here. Decimals not required. 217,904. Now listen carefully what has happened. Now, sir, you borrowed this particular amount, na sir. You did not repay. I will repay. Do you know how I will repay? From the receivable I will get after 3 months, I will repay this 3,50,000. Anyway, this and this will match, na. So what is the beauty here? See here. If you observe the entire scenario of money market hedging, the magic of money market hedging lies in Bhavishyat. I will tell everything that happens in future, but I will tell that today itself. Do you know what are all the aspects that we need to consider? Okay, see here. How much is the receivable after 3 months? 3,50,000. I can tell today itself because I already made the sale. Books law already recorded. Payment pending. Transaction already happened. So I can tell that I have to receive $3,50,000 today itself. Oh, okay. Number one. Okay. So next. You will borrow $3,42,298 when today. How do you know? On the basis of interest rates. So today, what is the interest rate? I went to the bank. I asked the banker. What is the interest rate that you are quoting? They said we are quoting an interest rate of 9%. 3 months ki how much? They said 2.25%. On that basis, I calculated. So today I went to the bank, asked them the rate. They gave me a rate. On that rate only I calculated that borrowing. Okay. So this is certain. Pakka certain. Okay. Conversion is certain. 100% certain. Same banker I asked, what is the dollar pound rate? He gave me 1.5905. On that basis, this amount came. Oh, so 2,15,214 is certain. 1,000% certain. Okay. Now what you will do with this? I will deposit. Deposit at what rate? Existing rate. What is the rate? 5%. Definitely this will become this much amount. So today itself we took all the actions which will mature in the future time. This borrowing will be coming to this much. This deposit will coming to this much. This all I can say today itself. Nothing is futuristic. Future happening is there. But future uncertainty is not there. Everything what happens in future, I can sit today and tell. That's the power of a hedging, a money market hedging. So now the last question for you that may get is, sir, you borrowed na, what you have, you didn't repay, we repaid. See, this borrowing will mature after 3 months and become 3,50,000. You will receive from your customer 3,50,000. This 3,50,000 will pay this 3,50,000 such that Forex receivable is paid through Forex payable. Forex receivable will be used to pay the Forex payable such that home currency to foreign currency conversion risk will not be there in future. Understood? This is the beauty of money market hedging. This is receivable. Payable structural changes will happen. Concept is same. What do you mean structural change? With the next question, we will do that together. Okay? 2,17,904 is the receipt you got for $3,50,000. Okay? Next. Let us take another question. Dangerous question. Let us take not this normal ones. Okay. Let's begin. Question number 55. Columbus Surgicals Incorporated is based in USA, has recently imported surgical raw materials from UK and has invoiced for pound 4,80,000 payable in 3 months. It has also exported surgical goods to India and France. Indian customer has been invoiced for pounds 1,38,000 payable in 3 months and France customer has been invoiced for 5,90,000 payable in 4 months. Okay, payable in 4 months. Current spot rate and forward rate. So spot rate was given, forward rate was given. Money market rates. Lower is deposit rate, higher is the borrowing rate. You as a treasury manager, you are required to show how the company can hedge its Forex exposure using the forward market and money market hedge and suggest the best hedging technique. Forward exposure you can easily do. I will do only money market hedging and I will show you the answer. Because our target now is to learn money market hedging, not forward bacha hedging. Okay. So that question. Read the question first before we go into solution. Please pause the video and see the question. Read the question. Now listen carefully. If you did not, please go back, pause the video, and then see. Okay, see here. Columbus Surgicals Incorporated is a company based in USA. It has imported, means it has payable. Okay, it has a payable in 3 months. It has also exported. Okay, this payable is for Indian company and French company. Okay, and these are actually receivables to them. Indian customer has been invoiced for. Okay, he has to pay us in 3 months. And there are 2 receivables and 1 payable. 2 receivables and 1 payable. Let's do it. Question number 55. Exposure summary. Okay, first one. Payable, receivable. First, payable. Who is from where he is importing? UK. 3 months. $4,80,000. Next, receivable. 2 transactions are there. One is India, 3 months, 1,38,000. Next, France, 4 months, 5,90,000. 5,90,000. First point number 1. For all of them, they accepted invoice in pounds. For easy netting policy, company might have done that. Anyway, that has nothing to do with this question. Just I'm telling you what does it mean. Okay. Okay. See here. So payable UK. UK we have to pay within 3 months. India we have to receive in 3 months. France also we have to receive in 4 months. We have to receive in 4 months. Is that question? So what he is asking, use the money market hedging and do something on this. Use what hedging? Money market hedging, and deal with all the 3 transactions. Okay, let us start doing it. See here. Here we can first understand one point. Same US company is having at the same timing 2 exposures which are matching each other. Means what? See, first one. Write down step 1. Exposure netting. Exposure netting. Payable in 3 months. Pounds 4,80,000. Receivable in 3 months. Pounds 1,38,000. So net payable. Write down $3,42,000. $3,42,000. What is $3,42,000? It is the net exposure we need to have. So we are having now 2 only. Now 1 payable is there, 1 receivable is there. For both of them, we need to have a MMH strategy. Okay, shall we do it together? Now, write down step 2. Step 2. MMH payable for pounds 3,42,000. For pounds 3,42,000. This question, if you can do properly, I am really saying no need to do any MMH question later on. So please concentrate and do. First, have 4 boxes as a tradition, convention. Have 4 boxes. Okay. Strategy we are using is MMH. First, have clarity. How many months? This will be a 3 months. Right. 3 months, 0 months. 3 months, 0 months. Okay, done. Next, in which currency invoice is made? Pounds. And we are having a payable. Payable or receivable? Payable. Write down first. We are having a payable. Pounds 3,42,000. Okay. Now pounds 3,42,000 is the receivable or payable? Payable. Now counter what we need to create? We need to create a receivable to the same value. Okay. 3,42,000. Write down up to here. 3,42,000. Do along with me. So 3,42,000. Payable is a liability. Receivable is a asset that we are creating. So we are having two things now. One is a payable, another one is a receivable. So payable 3,42,000, receivable also 3,42,000. We have to create now. Payable is already created. Receivable we have to create. Receivable, it should become how much? 3,42,000 after 3 months it should become. Means I need to have here a receivable, payable. Here there should be a receivable I should create. Means I need to create an asset or liability. Asset. Asset only will mature to 3,42,000. I repeat one more time. I need to have a receivable of 3,42,000. When that is already there, need to create. Maturity time it should become 3,42,000 receivable. To become a receivable here, today I need to create a asset or liability. Asset. Asset value of 3,42,000 pounds less than 3,42,000 pounds less than 3,42,000 pounds less than 3,42,000 pounds. How much it is? Present value. Right now. Deposit present value of exposure. Present value of exposure. Okay, listen first. Where you are depositing in pound. Pound there should be interest rate. Let's see. That is deposit interest rate. So what we need? We need pound deposit rate. See the question. Pound deposit rate 10%. Okay, 10%. Now write the formula. PV equal to FV divided by 1 plus R whole power n. FV we know 3,42,000 divided by 1 plus R whole power n. 1.1, sorry, 10% is for how many months? 1 year. 10 into 3 by 12, 2.5, 1.025. Pounds 3,33,658, 659. Okay, 3,42,000 divided by 1.025, 3,33,659. What is this 3,33,659? This will be the pounds. But listen carefully, here is a catch. Normally, when you do the receivables previous question, flow everyone will do. Okay, now listen carefully to the point. Okay, now my question. You are from which country? USA. You have to deposit in which currency? US pounds. UK pounds. In order to deposit in UK pounds, first you need to have some dollars with you. Those dollars you might have converted into pounds, and that pounds are deposited here. Correct? Repetition one more time for you. Listen carefully. How much you have to deposit here? I have to deposit pounds 3,33,659. Okay. Adi okay. You have to deposit 3,33,659. Yes. For that, what you first need? You have to take dollars to your US bank, give those dollars to him. Once you give dollars to them, those dollars they will convert it into pounds. And first you don't have dollars with you. If you really have dollars, you might have paid the payable itself directly. So you don't have dollars. Okay, now you need to borrow. How much you need to borrow? You need to borrow those many dollars at spot rate, which converts into 3,33,659 today. Okay, what? I told you na, receivable ki payable ki difference. This is receivable structure. payable key, structurally the concept will be different, but overall idea is same. Four boxes is same, future present is same, deposit borrowing is same, but the structure will change. Okay, receivable time we will go this way, payables time we will go this way. And at receivable time what we will do, from here to here we will go, here to here we will go. And do you know what is the logic behind all these things? First borrowing, next deposit. First borrowing, next deposit. Here we are doing what? Deposit. But first what should happen? Borrow. Therefore here to here. Previous example, already we are having a receivable, we are creating a payable. So borrowing is created here. So therefore like this we went. So always remember, borrow and deposit, not deposit and borrow. Okay, where borrowing is happening, that box you need to see first. Okay, so receivable key, this is a borrowing box. Therefore like this we went. Payable key, this is the borrowing box. Like this we should go. Clear everyone? So listen again, we have receivable, payable. Today na, after 3 months, after 3 months. Liability ya, asset, liability. Uncertain, certain, uncertain. Therefore when if you pay, uncertainty will not be there. If you pay today itself, then pay today itself. How to pay? Borrow and pay. Borrow and pay. How to borrow and pay? That's what we are going to see now. See, we will pay after 3 months only. We will pay after 3 months only. But the magic happens today. How we are going to do? See the screen. Point number 1. We are having a payable, which is a liability. We will now create a asset to the same value, which will mature not today, which will mature after 3 months. 3,42,000. Okay. Now, so therefore, in order to create a receivable, we should not borrow, we should deposit. We should deposit. Deposit full amount, then it will go beyond 3,42,000. So you should deposit that much amount, which will mature to 3,42,000. So present value. Using the pound borrowing rates, deposit rates, we consider this, we got 3,33,659 because this is pound. This is the deposit rate. Lower is deposit, higher is the borrowing. Here we are depositing. But to deposit this much amount, first you need to have some dollars, convert into this rate, correct? That we are going to do now. Okay, write down. Borrow dollars of such amount at spot, which converts to pounds, 3,33,659. So how much we need to borrow? Let us see. Now our arrow mark will be like this. Okay, our arrow mark will be like this. So at what rate? Spot rate. Spot of what and what? See the quotations given. See the quotations given. Tell me. Dollar and pound spot rate. What is given? Let us write down. $1 equal to pounds. $0.9830 Okay. What I said to you before, always see only the per unit currency. What is the per unit currency in the given question? Per unit currency is dollar. What is happening to dollar only you see. Remaining things you don't understand also. Forget about it. So we want spot of what and what? Pound by dollar. Pound by dollar spot rate we need. Okay. Now tell me. Pound spot rate we need. We have to borrow those many number of dollars which converts into 3,33,659 at spot. So first tell me. We wanted to borrow in which currency? Dollar. And we wanted to deposit. Deposit how much? 3,33,659. Now imagine this way. We want 3,33,659 pounds. And we wanted to deposit that. Means we wanted to buy the pounds. Okay. By doing what? By selling the dollar. Per unit dollar is there. Entire discussion, entire ideology, entire concept should be on dollar. What is happening to dollar? You borrowed $333,659, correct? After some amount of dollars which will convert into 333,659 pounds. What you have to do? You borrow dollar and convert dollar into pound and invest there. To convert that dollar, we have to sell dollar and buy the pound. So what is happening to the dollar? Sell. So we are selling the dollar. bank has to buy the dollar. Bank buys at a lower rate. Lower rate is the bid rate. So what is the bid rate? 0.9830. So $1 equal to pounds, 0.9830. We are having pounds, 333,659. How many dollars? Write down the answer directly here. So dollar 333, 330, 1 3 is missing. 333,659 divided by 0.9830. How much it is? 339,429. 339,429. What is the 339,429? 339,429 dollars you will borrow. Take calculator. 339,429. Okay, I borrowed this amount. We will convert that into pounds. At what rate? 0.9830. Right. Do this. Divided by, okay, sorry, multiplied by 0.9830. How much it came? 333,659. So we will deposit that. So that reconciliation also happened. So we will borrow $339,429, which will get converted into 333,659. 333,659. Take calculator. Take calculator. We will invest at 10%. 10% for 3 months na 2.5%, 1.025. Do it. Into 1.025. How much? 3,42,000. That's it. So this will automatically matures to this amount. 3,42,000. 3,42,000. Okay. Now you will borrow. You will borrow. Borrow in what? Pounds. When you borrow in pounds, you have to repay or not? Repay on maturity. Okay. How much you need to repay on maturity? See, you borrowed at what rate? US la you borrowed. US la borrowing 13% rate. So 13%. 13 into 3 by 12. 3.25 divided by 100 plus 1. 1.0325. So how to write? 339,429 into 1.0325. 1.0325 into 339,429. It is $350,460. This is the net payment using money market hedging. Okay. This is a net payment using money market hedging. So 350,460. Let us check whether this answer is right or not. 350,460. Exact 350,460. That's it. If you do properly, why it will not tell you? Yeah? Sometimes in 1 or 2 problems, because of that 4 decimal, 3 decimal inconsistency in the exam questions, answers tallying, small differences can come. 50 paisa, 60 paisa, decimal differences can come. Normally, change will not come. Exact answers will come. So 350,460 is the final answer. So what is the 350,460? Using money market hedging, this is the payment I am going to make. $350,460 for 3,42,000 pounds. Okay. This is all about how to do with the payables. So we have done with receivable one question. We have done with payable with one question. Deposit loan rates, different rates, and months also we have taken differently. Two-way quotations, so we have done. So what is more in that? That's it. This is how payables and receivables has to be done. Practice this question multiple times. Listen to the video if you want again. Then you will become perfect in this particular segment of money market hedging. Now we are done with MMH. Now we are going into next 2 areas. Okay. Bankers hedge, cancellations, extensions, and early honor. Next concept, keep the heading. Dealers are bankers hedging. Dealers are bankers hedging. Name itself is clear. Normally hedging is done by the customer. Now hedging is done by whom? The banker himself. Sir, why bank has to do hedging, sir? They can also, they are the main persons now. Why they have to do? Listen carefully, I will give you some examples. See, whenever you are having dollars with you, I'm talking about customer, Indian customer, having dollars, there is always a problem of rise in price and fall in price. Rise in price, very good, but fall in price a problem because the value will be reduced. Okay. So therefore, what is the problem here? Whenever we are having any kind of transactions in foreign exchange, having dollars with us is a risk. Reason, if the dollar prices fall, your wealth also will fall. Therefore, what is the problem here? Customer holding dollars is a risk for him because for customer, dollar is a foreign currency which will fluctuate up and down. He is subjected to gain as well as a loss. Okay, he is subjected to gain as well as a loss. This is one point. Tick. Second one. Now the question is, from the point of view of a banker, if you see India la banker, for example, there is a banker or exchange dealer, everyone. Let us say, for example, Western Union is there. Western Union is having $1 lakh with it. Okay. Western Union in India, for them, dollar is a home currency. Yeah. How Koushik Mukhesh dollar is a foreign currency, in the same way, also for Western Union, dollar is a foreign currency. Correct or not? How fluctuations will affect you, fluctuations almost will also affect them also in the same way. Therefore, when you have a risk of rise and fall in the prices of dollar, they are also having the same risk of rise and fall in the prices of dollar. So, whenever banker is subjected to a risk, he will go by a hedging strategy called as cross currency deal, also called as a covered deal. Also called as what deal? Covered deal. I will first explain you the concept clearly, like previous one. First 10-15 minutes, listen carefully to each and every point I repeat. After that, directly we will start doing the problems on this particular segment. That's it. Your concept will be completed by then. Okay. Listen carefully. So many students are asking me, sir, bankers hedging, okay, and currency options and currency futures. So many are asking. So therefore, in this segment, the most important aspects we are going to discuss. Okay. Let's see. Dealers hedging or bankers hedging. First, listen carefully. What will happen in a foreign exchange transaction? See. See here. There is a banker. There is a banker. What this banker will do, he will sit in the counter. Customer came. He sold dollar. Banker bought the dollar. Gave rupees. Another customer came. He bought the dollar and he gave rupee. This is how transactions happen with a Forex dealer. Okay, let us see, this is a Forex dealer. Banker means Forex dealer. Now here what is happening? Some people are coming and buying, some people are coming and selling. Anything can happen. Now listen carefully. $1 lakh are sold. Okay, $1 lakh are sold by customer to bank and a bank bought. Next case, what bank has done? Bank sold. Okay, how many dollars bank has sold? Let us say $1 lakh again. From this, what you have to understand, bank has done two transactions now. Okay, at a particular time period during a daytime, they have done two transactions. Number one, buying dollar. Number two, selling dollar. Bank point of view, see, bank bought a dollar, bank sold the dollar. How many dollars? $1 lakh bank has bought, $1 lakh bank has sold as well. Now, there is a matching in the transaction. What matching? Exposure matching happened. Means what? I bought $1 lakh. I am at risk now because the dollar value fall, my value will fall. But there is a ready customer for me who is ready to buy these $1 lakh today itself. So I will throw it in your hand. Dollar is always like a poisonous snake. It will bite you if you hold it. So throw it into other person's hand. Bank will really feel about dollar in the same way. So what happened? Banker is sitting. One person came and thrown the snake on his hands. Understood? He thrown the snake on his hand and said that give me money. He took money and he went. Now the poisonous snake is in the hands of the banker. Banker will look for another person, any other customer who want dollar. If he comes now, throw that snake into his hands. This is what banker will always do. From this, what is the moral of the story? Whenever the bankers are having a consciousness of not holding the dollar, what will happen? Whenever there is a counter customer, they try to throw the dollar into his hands. $1 lakh received, risk started, $1 lakh thrown, risk is squared up. Therefore, the banker is not at risk. This is one of the least possible example. In real life scenario, 1 lakh counter buy key, another 1 lakh counter sell may not come always. It may be higher, it may be lower. It may be higher, it may be lower. Therefore, the problem of mismatching will happen. What will happen? Mismatching will happen. Okay, listen carefully now. Okay. On a particular day, to a banker, a customer came and sold $1 lakh. Okay. Another customer came and he bought $80,000. Here, to be very clear, $1 lakh. So $1 lakh sold, $80,000 a bought, or reverse can happen one day. There is a banker, customer came, sold $1 lakh, customer came and bought $1,20,000. Okay, let us understand both the cases properly first. Okay, first case, customer came, sold a bought a, he sold dollar, took rupees and he went. $1 lakh are in the counter now, risk. Another customer came, bank was very happy, Abba, I can throw this into his hand. He took only $80,000. Now I am having a additional balance of $20,000. Okay, next case, there is a customer, that customer came, sold $1 lakh, but another customer came and asked for $1,20,000. So I am having a excess of $20,000 which is sold. I'm not telling negative balance. Sold in a negative, bought in a positive. In that way I have written. Okay. So now what will happen? There is a overbought position. There is a oversold position. There is a overbought position. There is a oversold position. Sir, what do you mean by overbought and oversold? When you use the word over, first there should be a limit. Beyond that we call as a over. So what is the limit? That will be decided by the treasury of that country or by the management of that particular bank. Okay. For example, if it is Western Union management decided that depending on the demand for dollars in India, that too in the city like Hyderabad, it is always ideal to hold not more than dollars, 1 lakh, not more than $1 lakh, and not less than $1 lakh. So simply to tell, they kept a standard limit. Always, whenever you see, your balance in dollars should be only 1 lakh. Don't go beyond 1 lakh. Don't go lower than 1 lakh. 1 lakh is a decent balance that you need to maintain at all the times. 1-2 days if fluctuation happen, again you have to bring it back to $1 lakh. $1 lakh should be a standard limit for the holding of dollars by Western Union Hyderabad branch. Management have decided maximum you should hold only $1 lakh in your reserves. Dollar reserve should be only $1 lakh. Don't go beyond, don't come below. Is that point. Number 2, now what happens? Let us see. Okay, first case, there is a customer who came, he sold me $1 lakh became 2 lakh. My limit is only 1 lakh. Now what I will do, I will first look for any other customer coming. He came, I thrown into his hands 80,000. I have thrown $1 lakh ki, another $1 lakh added, became $2 lakh. Another customer came, he took $1,80,000. Still I am having a balance of $80,000. Still I am having a balance of 1,20,000. I need to have only 1 lakh balance. I have 20,000. That 20,000 addition we call overbought. We call overbought position. Overbought position. Okay. Next, Second situation, my limit is only 1 lakh. Okay, 2 days I sold $1 lakh to a person. My dollar reserve became zero now. My dollar reserve became zero. Huh, sir, happy na sir? No dollars. Hey, no dollar means you can't do business in dollars now. You have to buy dollar. When you go to future and buy dollar, dollar price increase na. Today dollar is 90.23 rupees. Against dollar, it is 90.23 rupees. 85 rupees it became zero. Tomorrow if I buy 90 rupees, I need to buy $1 lakh ki 5 lakh loss. How much loss bank will maintain? So therefore, suddenly my balance became zero now. I need to bring it back to 1 lakh. I looked for a person who will sell me. A customer came and sold me. Okay, a customer came and sold me. So try to understand clearly. Okay, customer came. First case, customer sold 1 lakh, bought 1 lakh 80. Customer sold, let us say 1 lakh 20, bought 1 lakh, like this you will. Okay, customer bought means I sold $1 lakh. Dollar balance became zero. I found another customer. Anyone will come. Okay, a person came and he said that I will sell. I'm very happy. Amaya, I can buy. He sold me $1,20,000. My reserve came to 1,20,000 now. Okay, my reserve came to 1,20,000. Okay, this is how you can understand. Or it became zero, or you can understand this way also. See here, making a slight change. See here. See. For this, I will make a small change such that you can understand much clearly. See here. A customer came. He sold me. And I bought. First a customer came, bought $1 lakh. Bought how many dollars here? $1 lakh. Okay. Bought $1 lakh. Immediately after buying it, a customer came to me, and let us say for example, that fellow has sold me some dollars. That customer has sold the dollar. Okay, see here. Slightly, let us make the change to numbers. See, there is a banker. This banker is required to maintain $1 lakh balance at all the times. On a particular day, a customer came and sold $1 lakh. Let us use the same example. $1 lakh. And a bank bought $1 lakh. So bank bought $1 lakh. It became how much? $2 lakh. I thought, Amma, I am having excess balance. One person is coming. I asked, what you want? He said, I wanted to buy. Yeah, then I will sell. So immediately he said, I want $1,20,000. My balance came to 80,000 now. Okay. So 1 lakh became 2 lakh. And after that, I sold $1,20,000. And now the balance has become only how much? 80,000. I need to maintain 1 lakh balance, but it became 80,000. I have a oversold position of 20,000. Now you answer my question clearly. Whenever I am having a overbought position or oversold position, what is that over? One level is there. Up to 1 lakh, no risk. We are ready to take risk. Beyond that, $1 also is a overbought. Below that, any $1 also is a oversold. I don't want oversold. I don't want overbought. Okay, I don't want oversold. I don't even want overbought. I want exact balance to be maintained at all the times. That's all. Therefore, two situations can occur. Overbought situation, oversold situation. Overbought in our example, $20,000. Oversold in our example, $20,000. Now what to do? First step. Whenever there is a overbought, excess are there, I need to sell. Step 1. Banker will try to sell to another associate bank. Means the banker will call another associate bank. State Bank of India will call another branch. We have extra $20,000. Do you want? They said, yes, I want. They will give to them. Internal exchange and money transfers will happen. Done. But sometimes the branch will tell, no, we don't want. Then step 2. The banker will deal with other banks, not associate banks. Other banks they will deal. SBI will call HDFC and ask, Do you have enough reserves of dollars? If you don't have, I am ready to give it a prevailing rate. At the prevailing banker's quotation will be there, no lower rate. At that rate, I am ready to give. Okay. This banker will tell, I have extra $20,000. If you want, I will transfer to your account. Okay. Account is what account we are going to use as a Nostro account. We will see that later. So, so the bank will ask other bank, do you want $20,000? I have. That bank said, I want. Then negotiations will happen with that bank at a rate and they will transfer. There also no one is there. So what will happen? Associates, so no one is there. Other banks, so no one want. In this case, step 3, this banker will go to international bank. Which bank? International bank. International bank in the questions you always see in Forex, interbank rate. Interbank rate is this rate. Interbank means international bank. Hong Kong, Singapore, London. In these places, international banks are there. How stock exchanges ki main head office is in New York, like that. Forex ki various centers la head offices are there. Head offices like international banks they call. Means what? You can buy a dollar by going to USA. You can buy a dollar also in the international banks. Okay. International bank is a wholesale market. Indian banking, Forex banking is a retail market type. These all people will buy from them only. Hey, government of India will print dollars. From someone they have to buy. From whom they will buy? From international bank they will buy. Okay. Now listen to the story. So step 1. Here also same. I am having a oversold position. I wanted to buy. First bank will go to the associate bank. Associate bank, I want $20,000 to match my limit of 1 lakh. Can you please sell? I will buy at the prevailing rate. They said, no, I can't. We want. So step 2, this bank went to other banks and asked, other bank, can you please give me $20,000? I have to match with my reserve account, $1 lakh. They said, actually, I wanted to come to you and ask. I am also having a deficit in dollar. Okay. Step 3, when this 2 access is lost, then this banker will access to the international bank market. From there, they will buy. So here, oversold is made to international bank. Here, overbought is made to international bank. From this, what you have to understand, whenever we are having oversold position, whenever we are having a overbought position, we will not put our exposures uncovered. We have to hedge ourselves. That's why bankers hedge is the name. We have to hedge ourselves by taking a counter position in interbank market and square up our position immediately such that the risk will be negated. So what they will do, now the banker in India will go to the international bank. He will tell to the Singapore banker, okay, I have extra $20,000. I have extra $20,000. Can I sell? They will tell, okay, come and sell. So I will go to interbank market and I will try to sell my $20,000. Now listen. Who are we? Banker. Banker here, overbought or oversold? Overbought. Overbought, we have to reduce means what we need to do? Sell. So our banker wanted to sell. Bank sells dollar. Bank sells at what rate? Higher rate. Higher rate will be what rate? Ask rate. Like this, you should not think. If you do like this, answers will go wrong. Now listen. We are bacha in front of our bank. Our bank is a bacha in front of international bank. How you tortured me with a higher rate of ask rate when I am buying, lower rate of bid rate when I am selling. Same torture now they will put to our banker. Therefore, what will happen in this case? Interbank market la, our bank is a bacha. This fellow will go to interbank. Interbank. I have extra $20,000. I wanted to sell. Now listen from the interbank market point of view. Interbank market has to buy your $20,000. Interbank buys at a lower rate. Our bank sells at a lower rate. Interbank buys at a lower rate. Lower rate is a bid rate. Here bid rate will apply. Okay. Normally, whenever bank selling means what will apply? Ask will apply. Therefore, students will automatically write ask. But answer the bid will be there. Here, banker is buying dollar. Banker generally buys at what rate? Bid rate. But here, where you are buying interbank, you have to buy at ask rate. Therefore, answer exactly reverse ask will be there. Therefore, do you know what is the student community doing in general? Whenever the questions on banker hedging is coming, they will first understand the transaction. Bid or ask will come. Answer reverse will be there. Like that they are thinking. See, means they will get bid na, they will tell, okay, I got bid na, answer ask will be there. I got asked, then answer a bit will be there. Like that they are doing without knowing the concept, what is behind this. So to the interbank, you are a customer. Therefore, you have to buy at a higher rate being ask rate. You have to sell at a lower rate being a bid rate. That's how these bankers hedging questions are coming in exam. Everybody in the class understood the logic clearly or not? See here. Let us do a question now. Not one. 3 questions I will do for you. Okay. Let us do the question number 4. English Bank Limited sold Hong Kong dollar 10 crore value spot to its customer at rupees 9.7. First, imagine you are a banker. Banker sold. Okay, sold means dollars are going out. Which dollar? Hong Kong dollar. 10 crore value spot to its customer at 9.7. And covered itself. Covering means hedging in the London market, international bank, on the same day when exchange rates are $1 equal to Hong Kong dollar so much. Local interbank rates for US dollar were spot $1 equal to rupees 74.7 and 74.85. Calculate the cover rate and ascertain the profit or loss of the transaction. Ignore brokerage. Figures are to be rounded off to 4 decimals. Read the question first before we go into solution. Okay, so let us do the solution. See here what has happened in the question. English Bank Limited sold Hong Kong dollar 10 crore value spot to its customer at 9.7 and covered itself in the London market on the same day when exchange rates were so and so. Local interbank rates so and so. Okay. Interbank, international bank lo what we have done? Dollar Hong Kong dollar exchange ke international bank we used. Dollar rupee local market it is available. So local interbank means in India also the international bank branches are there, local branches. A local it is available, dollar to rupee quotation. But a dollar to Hong Kong dollar quotation is not available here. That's why we are going into that London market and we are asking for the exchange rates to buy. Sorry, easy way to understand this question. See here. You are a bank. Customer came to you. He said, bank, I want 10 crore Hong Kong dollars. Banker got fits. 10 crore Hong Kong dollars. Hong Kong dollars we don't have. How can we sell you Hong Kong dollars? So then he said that, no, I want 10 crore Hong Kong dollar. Then I said, we as a banker said to him, sir, you have your seat. 2 minutes, you give me time. We went. We called the Interbank. We asked, Interbank, do you have Hong Kong dollars? 1 crore Hong Kong dollars I want. 1 crore Hong Kong dollars. They saw and said, yes, we are having Hong Kong dollars, 1 crore. Okay, I will buy. Okay, you wanted to buy. Then what we will tell, give me a quotation for this 1 crore, 10 crore dollars ki, 10 crore Hong Kong dollars I will buy na. Each Hong Kong dollar ki, how much rupees I have to pay? Give me one quotation. Then they said, 2 quotations they gave. So rupee to Hong Kong dollar is not quoted. I can give you 2 different quotations. Rupee to dollar I will give local rate. Dollar to Hong Kong dollar I will give. You calculate cross currency quotation. Then they gave like this. They said, one US dollar equal to Hong Kong dollar 7.7506, 7.7546. $1 equal to rupees 74.7, 74.85. They gave 2 quotation. This is local market available. This is international bank market available. Quotation you calculate. At that price, I will give you 10 crore Hong Kong dollars bank said. So tell me, what is the story now? What is the drama? Customer came to the banker, asked 10 crore Hong Kong dollar. Bank called international bank. First point, India, Hong Kong dollars, which fool will buy? No one will buy. No one will maintain even reserve. Dollar ki 1 lakh reserve is ideal because many people will trade in dollar. Universally acceptable. Hong Kong dollar who will trade? Why I will put it unnecessarily when there is no mobility and liquidity for that currency. Therefore, we have 0 Hong Kong dollar. We have 0 Hong Kong dollar. We don't have any Hong Kong dollars with us. Okay, customer came and said, I want 10 crore Hong Kong dollar. We said, we will not tell no, na. We will do business. Whenever a good businessman, whenever you see, when he don't have, na, he will not let the customer go out. He will go to another shop and bring it. Same thing we are also doing now. Banker will call international bank. International bank. One fellow is sitting there. He wanted 10 crore Hong Kong dollar. I wanted to give him by buying from you. So you please tell me at what price you will sell me. It said, I will not tell you the rate. I will give you quotations. You compute and tell me. They gave this. Now tell me the answer. We are bankers. We are buying from international bank. Okay, we are buying from international bank. Hong Kong dollars. International bank has to sell. Okay, international bank sells at a higher rate. Higher rate will be ask rate. Now banker will know the pain of buying at a ask rate. How he will torture the public. Now he will torture the banker. Normally bank always buys at a lower rate. Here bank has to buy at a higher rate because to the international bank, this bank is a customer. This bank is a customer. So now repeat the statement. How to understand? International bank, we went. We are buying from international bank. International bank has to sell. Interbank sells at higher rate. Higher rate is ask rate. Ask of, first write down denominator currency, Hong Kong dollar against to rupee. But rupee to Hong Kong dollar is not quoted. So we will use cross currency rule. A by C equal to A by B into B by C. So ask of rupee by Hong Kong dollar can be written as ask of rupee by A is rupee, C is Hong Kong dollar, B is dollar. A by B, ask of rupee by dollar into ask of what is B? Dollar. Dollar by Hong Kong dollar. Okay. Ask of rupee by dollar. Sorry. Into quotation. If you observe this quotation, denominator of dollar is there, but here denominator of Hong Kong dollar is there. So whenever ask of dollar by is there, it is one of the direct quotation. Convert reverse. So what we will do? That's why rules, basic rules, you should never forget. This can be written as 1 by, when you do 1 by inverse, direct will be converted into indirect. 1 by bid of Hong Kong dollar by dollar. I think you all know this basic rule. How it got, don't ask me, the basic of Forex chapter. Okay, so given quotation, ask of rupee by dollar 74.85 into 1 by bid of Hong Kong dollar by dollar 7.7506. That equal to 74.85 divided by 7.7506. It comes to 9.6573. 9.6573. What is 9.6573? This is the rate quoted for Hong Kong dollar against a rupee by the Interbank. Do you know the beauty of this transaction? First we will call him. He will give us a quotation. How much quotation? 9.65. We will add some profit and we gave 9.7 as a quotation to the customer. See how the business is done. How beautifully they brought the question also into the exam. So directly you will not give a rate. See, customer came, you will not tell 9.7 I will sell. Then we called international bank. He said 9.8. Gone. Your promise is gone. That's why we will not tell any rate unless he confirm. He confirmed 9.673, then we will tell by adding some commission 9.7. That's how this question has to be read. Okay. Now tell me, what is the banker buying rate? 9.6573. What is the banker selling rate? 9.7000. Okay, 9.7000. 4 decimals he asked us to do, 4 decimals. Because why they stressed on 4 decimal? Here 2 decimals is used, here 4 decimals is used. Confusion. 2 or 4. And here again 2 decimals came. 2 or 4. Therefore they gave clarity. No clarity came, assumption. You have to write an assumption in the exam. Okay. So calculate the cover rate. Cover rate is 9.6573. The rate at which you covered yourself in the market. Cover rate. And ascertain the profit or loss. See here. Now what is my profit? Profit per Hong Kong dollar equal to rupees 9.6573 minus 9.7. Profit is 0.0427. Okay, 0.0427. This into 10 crore. 42 lakh 70,000. 42 lakh 70,000. Perfect. Khatam. Tata. Goodbye. If you do properly now, like this, answers will tally. Okay. So this is a cover rate. This is the total profit or loss. Okay. Shall we do another question? See this question. Edelweiss Bank Limited sold Hong Kong. Hey, Hong Kong dollar obsession. Okay. So Edelweiss Bank Limited sold Hong Kong dollar 2 crore value spot to a customer at 8.025 and covered itself in the London Bank on the same day when exchange rates were so and so. Calculate the cover rate. Okay. Calculate the cover rate. Okay. Let us do it. How to understand? Customer came to us, asked for 2 crore Hong Kong dollar. We don't have even 1 Hong Kong dollar. We directly went to the London market on the same day and we asked them what is the rate. They gave us 2 rates. Okay, they asked you compute. Okay, they asked you compute. So let us do together here itself. Practice along with me. So we wanted to buy Hong Kong dollar in Interbank. Interbank has to sell. It sells at higher rate. Higher rate will be ask rate. So ask of rupee by Hong Kong dollar. But rupee by Hong Kong dollar is quoted or not quoted? Not quoted. Therefore, we will do cross currency. Ask of rupee by dollar 7.5920. Ask of rupee by dollar, dollar by Hong Kong dollar. But given quotation is Hong Kong dollar by dollar. Therefore, 1 by bid 7.5880. 7.5920 divided by 7.5880. Okay, 7.5880. Calculate and compute the number. Okay. See, sorry. Very sorry. Rupee by dollar. Ask 61. I'm very sorry. 61. So 61 divided by 7.5880. Okay. So rupee by, how to write this quotation? Ask of rupee by dollar into ask of dollar by Hong Kong dollar. Okay. Rupee by dollar ask 61. Rupee by dollar ask 61. Ask of dollar by Hong Kong dollar. But given quotation is Hong Kong dollar by dollar. Therefore, we have to reverse it. Reverse ask will become bid 1 by ask of 1 by bid of Hong Kong dollar. This amount we have written. Bid will be 7.5880. So 61 divided by 7.5880. 8.039. 8.0390. So what is this? This is a cover rate. What is the profit? I promised them at 8.025. Okay, 8.025. But I am buying it at how much? 8.039. These are false commitments that banks can give. See here. 8.039 or selling rate 8.025 to the customer minus 8.039 minus 0.014. We got a loss here. How much loss? Into 2 crore. 2,80,000. Perfect. It's a loss to the bank. Sir, why bank will make loss, sir? See, exam question they will give circus questions like this, but no one will actually do. Okay, people won't actually do like this. Okay, so therefore, problem ki you do. Really bank will do now means generally banks won't do. But question is there, we have to do, that's it. Okay, but there is a loss here. We have done 2 questions on this. Okay, so that's it. These are all the questions that you can do on dealers hedging. So, let's do one thing. There is one unique question on this. Let us also do this. Then in a worst case scenario, even a different question comes in exam, you will be able to solve. Okay. Let me copy this question. Okay, see here. Very much a unique kind of question. Let us also do this. Never you will get any doubt on this again. Your Forex dealer had entered into a cross currency deal and had sold US dollar 10 lakh against a euro at $1 equal to euro 1.4400 for spot delivery. However, later during the day, same day, the markets became volatile and the dealer in compliance with the management guidelines have to square up the position when the quotations are as under. What will be the gain or loss in the transaction? Okay, I will pause the video. Please, you also pause the video, read the question first, what is happening. Don't sit idle. You pause the video, I will continue. So you pause and see the question first, read it properly. Read the question. Okay, I hope you pause the video and you have done that. Okay, so your forex dealer had entered into a cross currency deal and had sold US dollar 10 lakh against the euro at US dollar 1, which will be euro 1.4400 for spot delivery. However, later during the day, market became volatile and the dealer, in compliance with the management's guidelines, had to square up the position when the quotations were so and so. What will be the gain or loss? Do you know what is the uniqueness of this question? See, when I discuss about a Nostro account and exchange position account later after this, you will really match the points also. But as of now, listen carefully. India, there are so many forex bankers, 100 above forex bankers are there. Okay, exchange dealers and this people will be there now, authorized dealers around 122 or 123 plus authorized dealer category 1 bank, category 2 banks are there in India. And there are so many forex persons dealing in India. Every forex dealer will not just have rupee and dollar, will have so many other currencies also. Sometimes what will happen is some customers in India will come. Okay, some customers in India will come, or some customers outside India also can come. They will tell, I want a quotation, I want a transaction to happen in dollar. For example, a person in India will ask, I want dollars. I want to buy dollars. Okay, I wanted to buy dollar. Okay. Now, in the previous example, you remember Hong Kong dollar transaction we saw. In that Hong Kong dollar transaction, what happened? We said for Hong Kong dollar 9.7 rupee. 9.7 rupee we quoted. Correct? But listen, there are so many exporters in India. There are so many what? Exporters in India. These exporters are having foreign currency accounts with them. Okay. For example, Tata Iron and Steel Limited, if you take, Tata Iron and Steel is such a big company. They are having branches throughout the globe. Okay. For example, my company is having a unit in Germany. Okay, a unit in Europe, where the currency is euros. I am Tata company, Tata Iron and Steel. We are selling also to the people in Europe. Those people we are invoicing in euro. Euro will come to India. I will not convert into rupee. Tata, since it is a frequent exporter, you can open an account called as a RFC account. Famala, I said you. RFC account means what? Resident foreign currency account. Resident foreign currency account. You are a resident, but you can open foreign currency account. So Tata company opened a foreign currency account, euro. So now what happened? I sold to a person in Germany. That German person has given me euro. I did not convert them into rupee. I kept in my euro RFC account. In that it is there. Now I am the customer. I went to bank. I went to forex dealer and I asked forex dealer, I want 10 lakh dollar. I want 10 lakh dollar. Forex dealer said that, in which currency you wanted to pay? I wanted to throw my euros now. Therefore, what I said, I will give you euros. Means in the previous example, Hong Kong dollars were bought by the customer by giving rupees at 9.7. Now the customer said that, Tata company said that in this example, what I said, I have euros already. I want dollar. You give me quotation between euro and dollar. We are Indians, but give quotation in that such that I can throw euros to you. That's the question here. Do you know what is the question? The importance of this question. You observe the question, what is there here? You are a forex dealer. Okay? Okay. Now, see here. What you are doing, see, there is a customer. Okay. There is a customer. So, there is a customer and you are the forex dealer. What you have done is, you have sold 10 lakh. Okay. Next, what you have to get in return? Rupees generally, but this fellow gave you euros. He gave you euros. How much euros? $10 lakh. $1 equal to euro 1.44. 10 lakh dollars means totally 10 lakh into 1.44. So 14 lakh 40,000 euros. So tell me, in our example, let us call it Tata Iron and Steel Company Limited. Tata Iron and Steel Company Limited had sold 14 lakh 40,000 euros. FD bought, Forex dealer bought, and Forex dealer sold $1 lakh. Tisco has bought. See here, that's why what they say, Forex dealer sold $10 lakh. Forex dealer sold $10 lakh. Customer bought. Forex dealer in return against what currency? Euros he bought. Now two things happened now. How many things here? Two things have happened. Number one, I have sold euro, I have sold dollars and I bought euros. How much euro? 14 lakh 40. 14 lakh 40. Okay. Now listen carefully to the point. Okay. Listen carefully to the point. Okay. See now. Now how many euros I am having? Now what happened is, the position what happened here is, I am having 10 lakh dollars lesser. I have 14 lakh 40,000 euros with me. So because of the customer, unnecessary euros came to me, necessary dollars went out. Okay, necessary dollars went out. Normally when you transact with rupee dollar, rupee euro, one is anyway home currency. I will target only on one currency. Here two things happened at the same time to me. What are the two things? What is required for me? $10 lakh went out. What is not required? Euro came in. Therefore do one thing. On the same day, first what happened? Customer came to you. Customer said that I will give you euro, you give me dollar. He gave you euro, you gave him dollar. Over. So here problem is, both are foreign exchange asset to the dealer. Both are risky. Therefore what happened? Now try to counter the transaction. What we will do? I want dollar. See, customer came. I gave him $10 lakh. $10 lakh deficit. Euros came. Excess. Now what you do? Anyway deficit is there now. Fill the deficit. Instead of paying in rupee, pay these euros again. Therefore what happened? Now this is step number 1. Step number 2. Sell euros and buy $10 lakh in the interbank market. In the interbank market. So interbank market la we wanted to do what? We wanted to buy dollar. Interbank market la we wanted to buy dollar. We wanted to buy dollar. Okay. We wanted to buy dollar through euros. We wanted to buy dollar by selling euros. We wanted to buy dollar. Interbank has to sell dollar. Interbank sells at a higher rate. Higher rate will be the ask rate. So ask of euro by dollar. Ask of euro by dollar, what is the rate? Dollar euro 1.4350. 1.4350. So $1 equal to euro 1.4350. We have $10 lakh we want. So how much? 10 lakh into 1.4350. 14 lakh 35,000 euros. What will happen? We will sell. We will sell. So what happened in this case? Tell me what has happened. From this, how to understand? Simply to tell, 14 lakh 35,000 euros we sold. 14 lakh 40,000 euros we bought. Okay, we bought 14 lakh $40,000 and we sold only 14 lakh $35,000. Means we are having excess of 5,000 euros still with me. Correct? We have extra $5,000. It's a profit to us actually. So let us understand again. A customer came to you. Customers wanted to buy $10 lakh. by 10 lakh dollar, and he wanted to exchange the dollar not through rupee but through euro. How many euros he thrown on our face? 14 lakh 40,000 euros at 1.44 rate to dollar. He thrown us euro and he took dollar. Now I got excess pound, excess euros, deficit dollars. Therefore, when I saw there is a transaction in the interbank market between euro and dollar, directly I went to the interbank and said that interbank, no rupee. I have euros, I will give you, and I will take dollar. Taking dollar means we have to buy dollar. We have to sell euro. Okay, we will buy dollar. How many dollars? 10 lakh dollar. So 10 lakh dollars we will buy. So we buy 10 lakh dollars, okay, by selling euro to the interbank. Interbank will sell dollar at higher rate. Higher rate is ask rate. Okay, ask of euro by dollar. Dollar is a per unit currency here. Why we are buying and selling in dollar? That should be in per unit. 1.4350. So how many dollars? 14 lakh 35. Do you know from this how to understand? 10 lakh dollars we sold to customer by taking 14 lakh 40,000 euros. Correct? But the same 10 lakh dollars we bought in interbank at only 14 lakh 35,000 euros. Means what? 5,000 euro gain we made. Excess is a gain here. So we got 14 lakh 40,000 euro and we bought the same back at 14 lakh 35. That's the power of interbank. Interbank is like a wholesale market. You will find the prices at a lower rates. India brokerages, all those things will get added. So in the interbank, it is wholesale price. Lower prices it is available. So 14 lakh $35,000 I got the 10 lakh dollar. So I bought. Now I made a gain of 5,000. Simply instead of calling it a gain, squaring up is not exact. He asked what? He asked square up the position. Means what? Make it zero. I don't want any balance in euro. Make it zero. So now what we will do? You have to sell these euros. We have to sell these euros and get your rupee back. Sir, why not dollar? Dollar already 10 lakh you got. Na? 10 lakh is the balance you want. 10 lakh you got. Over. You got dollar, forget about it. Now excess euros we have to sell. Sell and get the rupees. Such that dollar is not getting affected. So we wanted to sell euro in the interbank. Interbank has to buy euro. Interbank buys at a lower rate. Lower rate is a bid rate. I repeat one more time. Listen carefully. We have excess 5,000 euro. We wanted to sell them. Interbank we have to sell the excess euro. We will sell euro. Interbank has to buy euro. Interbank buys at a lower rate. Lower rate is a bid rate. Lower rate is a bid rate. See here, bid rate. Rupee by euro. But directly not quoted. Na? Therefore, what we will do? Rupee by dollar. Dollar by euro. Rupee by bid of rupee by dollar. 61.43. Bid of dollar by euro. Given is euro by dollar. Therefore, 1 by ask. Okay. This answer came to 42.8084. 42.8084. What is 42.8084? At this price, okay, at this price, we have to get it. So if you sell na, for each euro, you will get this much. So total rupee realization equal to 42.8084 into 5,000. 2,14,042 rupees you will get in rupee profit. 5,000 profit hai na? Rupee conversion you get 2,14,042. Okay, see here, see the answer. Where is it? Perfect. 1 rupee also change doesn't come. That's it. See, the exam answer, this study material answer, I mean past exam question answer, RTP also came. But how to present that I shown you now. So what is the logic of that answer I told you. Okay. So this is how questions can be tested on banker's dealer or a dealer's hedging positions. Like these questions can come. So 3 questions we have done as promised. Okay. Now final touch to this. What is it? Nostro exchange position account. Nostro and exchange position account. Let us understand what is this Nostro and exchange position accounts. Okay. See here. Okay. Clear? We have done 3 problems as promised. Now we are going to start with Nostro and exchange position account, or exchange position account and Nostro account. Okay. Now, listen carefully. As we already discussed, whenever I am a Forex dealer, I am always subjected to a risk of having excess or having a deficit. Excess dollars are there na, I am having a fear of fall in prices when I go to sell. Lower dollars, deficit dollars are there na, I am having a fear that I have to pay higher price when I want to buy dollar. Therefore, management of a bank will always decide a threshold limit. Beyond that, you should not have. Lower than that, you should not hold. Okay. So, whenever you are having any excess holding, sell that. Whenever you are having a deficit holding, you have to buy that. This is what we discussed. Correct? Okay. Done. Next point. Next point. Listen. Whenever you are a person, you are having a physical cash with you. Whenever you are a person having a physical cash with you, whenever you are having a physical cash, what you will do? You will put it in a locker safely. Hey, 100 rupee, 50 rupee, 1000, 2000, okay. Lakhs and crores of money is there, physical cash. Okay, what you will do? You will put it in a bank locker, or you will put it in a deposit, or you will put it inside your home, inside a particular almara, safe locker. You will put and you will lock. Why? Rupee is valuable for us. Rupee is valuable for us. Okay, now, rupee is a foreign currency for me. Avuna? Foreign currency, a rupee. Rupee is a home currency for us. Dollar is a foreign currency. Dollar is a foreign currency. Rupee is home currency. Forget about it. As a normal individual, all of us, rupee is always secure for us. Means what? Simply we feel that rupee is always subjected to risk. Some people can come and do the theft or stealing, something like that. So therefore, we will always keep it in a safe locker. Okay. Now listen carefully. You go to State Bank of India Forex branch. Forex branch. Okay. You ask them, I want $1 crore. Okay. They will ask, come with me. There is a currency chest. I will open locker. All dollars will be there. How dollar is a risky currency for you? Dollar is same risky also for the bank. How we keep rupee not with us? We will put it in a bank account and hold a bank account number. Our State Bank of India also will feel the same problem with the dollars. That's why how Koushik Mukhesh will put all his money in a bank and have a bank account. Our banks in India will hold foreign currency also, not physically, but through an account maintained. That account what our bank is maintaining with another bank outside India for whom this foreign currency is a home currency, that account we call Nostro account. For example, see here. How to understand this? For example, I am a bank in India, Canara Bank. Okay, I am a Canara Bank. Now, what is this Canara Bank Forex division will do? It will take foreign currency, it will sell foreign currency. Okay. How? Not physically. If you go and ask, give me $1 lakh na, and bag they will not pack and give. $2,000 above as per FEMA, you should not hold foreign exchange. They will not give you. They will tell, sir, what you want? I wanted to pay. You wanted to pay na? To whom? To Mr. A in USA. Okay. You do one thing. I will tell you quotation. I will tell you how much rupees you have to give me. You give me that. I will pay to his account directly. How? I have an account. From my account to his account, I will transfer. Understood the point or not? Means I will not pack you $1 lakh. You will not bundle them and send by ship $1 lakh. The cinema na. So you won't do that way. In reality, how the Forex dealing will happen? You will go to a banker. You will tell, I wanted to buy $1 lakh. He will tell, sir, dollar to rupee 90 rupees. So pay 90 lakh. You will give 90 lakhs and you will give the bank account number of that person. That's it. Bank, India Bank will transfer dollar from its account to the dollar account of that fellow. Directly they will transfer. Okay. So you will not do anything. This is called as Nostro transaction. Nostro account means what? It is an account opened by a dealer with another dealer for whom that currency is a home currency. Citibank of USA, Bank of America in USA. What is their home currency? Dollar. With them, I will open account. See, Koushik Mukhesh is a customer opening account with SBI. SBI is a customer opening account with Bank of America. Now you can understand clearly. How I open rupee account with SBI, SBI will open dollar account with the Bank of America. Clear? Like this, State Bank of India, Canara Bank, like this, big banks are there. Na? All popular currencies, they are having accounts. Okay. For example, mine is a small bank. Mine is a small bank. Okay. Private bank mine is. Now answer my question. I may not be capable of opening 20, 30 currencies or Nostro accounts. I can't open. That much customer base I don't have. But suddenly one customer came to me. He said, bank, I want Hong Kong dollar 1 lakh. I said, sir, I have only dollar, euro, pound and yen. But we don't have, okay, dollar, euro, pound, yen. But we don't have Hong Kong dollar, sir. He said, no, I want Hong Kong dollars only. I want Hong Kong because invoice is made in Hong Kong dollars. I must pay. I don't want to lose the customer. Then my private bank will call HDFC, Forex division. I will ask, sir, do you have Hong Kong dollar Nostro account with you? Means, did your bank opened any Hong Kong dollar account with any other bank in Hong Kong? They said, yes, sir. HSBC, I have account. Hong Kong Shanghai Banking Corporation, HSBC. HSBC Nostro account I have. We are having somewhere around 10, 11 lakh of Hong Kong dollars. Do you want? Yes, I said, yes, sir. Can I use your Nostro account for one transaction? Can you please divide that Nostro account and give me the access? The access given by Indian bank of its Nostro to another person. That small access given to me, I call it LORO account. LORO. LORO. It's called as a LORO account. LORO account is an account which is a Nostro part of balance given to some other person who don't have Nostro account with that particular currency. Okay. This is Nostro account concept. Okay. Next. Sir, what is exchange position account? Okay. What is exchange position account? Exchange position account is an account which take care of all the demand and supply of Forex of a particular currency. Means what? It will track what are all the transactions that are happening in the bank. Sir, I didn't understand. See, in a normal company, cash transactions, credit transactions, both will happen. What do we mean by cash transaction? Came, paid money and took. Credit means transaction promised, payment will be made at a later date. Same thing. Same thing. Exchange position account, cash position account. Cash position account ke name Nostro account. Okay. See. Exchange position account will have, it is like a, this one. Exchange position account is like a purchase account and sale account. Okay. In a books of account. Cash position is like bank passbook. Bank passbook. Only what really affected bank cash, that only will come here. Okay. But purchase sale account, credit purchase will be there, cash purchase also will be there. Credit sale will be there, cash sale also will be there. So, buy, sell, debit, credit. These are the things that will happen in both the accounts. Okay. Okay. See here. There is a customer. That customer came to us and said, I wanted to, is it dollar. Every currency accounts we have to open separately. A customer came to us and said, I wanted to buy dollar at spot. I wanted to buy dollar at spot. Hey, understand all these from the bank point of view. Customer said that I will sell. Bank is buying the dollar. Here it will get affected. Sale will not get affected. Okay. Bank passbook, I said. What passbook? Yeah? Bank passbook type. Cash position account is like a bank passbook. So dollars will be credited if you buy. Dollars will be credited if you buy. So both will get affected. Exchange position account, cash position account. Okay. Dollar forward buy. Bank said that I will buy after 3 months. Buy will get affected. Sell will not get affected. Nostro is not going to get affected in any way because really there is no cash transaction. Only contract entered today. Only contract entered today. What is not done? What is not done? Actual transaction will be happening after 3 months. At the time, this will get affected. Dollar forward buy executed. Really happened. Now this will not get affected because already when they entered into contract, they affected the exchange position account. Now we bought na immediately, this will get affected and again dash. Okay. Now dollar forward sell, dollar forward sell after 3 months, exchange position account will get affected. This will not get affected. Okay. Dollar forward sell cancelled. He said I will do, but after 2 months he came and said Tucha I will not do. Cancel the contract. Now what we have to do? Dollar, when you said you sell, I already recorded in my exchange position account. Now you are coming and telling I cannot sell. Okay, simply to tell, we entered into forward sell. Banker said I will sell. Customer said I will buy. Okay, therefore for the bank it is a sale of dollar. I have recorded as a sale. Customer came after 2 months and said, sorry, I will not buy. I wanted to cancel. Means I will sell, can't sell, can't sell. Therefore, I will strike off this transaction. Already recorded. How can you change it? You can't tamper with the books of accounts. That too with the Forex books. So what you have to do? You have to counter. You have to counter. And you have to create a contra entry for that. What we will do? When sell, forward sell is written here, we will write forward sale cancellation as a buy transaction. That's why this is the reason cancellation extension early on our concept is there. Whenever cancellation happened, buy sell will be created. Why? Because of this reason only. Because in Forex, always you can't cancel outright. You have to counter the cancellation. You have to counter with cancellation. Means what? You said customer said that I will buy. I said I will sell, but you are not buying. That means I can't sell. Means what I will do? I will create a contra entry for that. This will be net off with this. Hey, even in your bank statement, what will happen? By mistake, bank has debited some charges to you, which should not be. Immediately they came to know that they should not do. 1 hour they will again reverse. They will strike off. They will reverse it. Why? Once recorded, you cannot change. Okay, so therefore, dollar forward sell cancellation is a reversal. You have to write as a buy. Here will not get affected. Next part. Dollar DD sold. DD sold. Okay, you gave me money. I created DD in the name of a university. Sale of dollar. So therefore, sale will get affected. Okay, dollar, DD sold. Nostro account won't get affected. Dollar DD honored. Okay, no effect. Dollars went out. It debits my account. Okay, next one. Okay, now. So this is how we need to understand. Like this, exchange position account, cash position will get affected. So management will tell how much balance you should maintain here, how much balance you should maintain here. Accordingly, we have to do the questions and answers coming in exam. Okay, shall we do a question now? Let's do one question which contains all the areas inside this. Say this question. Say this question. You as a dealer in foreign exchange have the following position in Swiss francs on 31st October 2022. Swiss francs, balance in Nostro account credit 1 lakh, opening position overbought 50,000, Nostro credit balance is there, overbought position is there. Purchase the bill on Zurich. Okay, Zurich means Swiss francs. Okay, question is given on Swiss francs. Another name is Zurich. It's a Zurich. It's not Zurich. CH should be read as Sha. Sir, anyway, whether you read Sha or Cha, answer will not change. You read it. So purchase the bill on Zurich. Sold forward TT, telegraphic transfer. Forward means forward contract. TT means telegraph. Next, forward purchase contract cancelled. Forward purchase contract cancelled. Okay, purchase contract cancel will be written on sale side. Remitted by TT means spot. Okay, forward TT. Remitted by TT means spot. Remittance means sale. Draft on Zurich cancelled. Okay, what steps you take if you require to maintain a credit balance of 30,000 in Nostro? So 1 lakh should not be there, 30,000 should be there. And overbought position should be brought to 10,000. I don't want 50,000, I want only 10,000. Okay, this is the question they are asking. Good question, na? So read the question first before we go with the solution. Read the question. 5 minutes, we will complete this answer also. Read the question. See here. So first, Let us take the question. This is the question. Let us open both the accounts. Okay, both. Let us do one by one all the transactions. Let us play. Same questions will come in exam if they have to ask, because there is no great newly what they can ask in this, nothing. So same things with small minor changes. Balance in Nostro credit. Opening balance 1 lakh. Credit balance. Next, one adjustment over. Opening position overbought. More buying is there, 50,000. This is the opening position. 2 adjustments done. Next, purchased bill on jurish. Okay, purchased the bill on jurish means buy. Bill purchased, not at discounted. Okay. Bill purchase 80,000. Buy. But here that will not affect. Why that will not affect here? Purchase a, not at discounted, not at honored. Okay. Next. Sold forward TT. Forward means forward, sale, forward sale. Forward sale 60,000. Okay, here it will not get affected. Reason why it will not get affected here? Because forward sale, this column is not required actually. Opening balance already written now. So why forward sale will not affect? Forward sale means we will sell in the future. As of now, there is no cash impact. So this will not get affected. Done. Next, forward purchase contract cancelled. Okay, last month forward purchase one person promised. When forward purchase when he done, I might have written like this here. Okay, now it is cancelled. I have to write in this sale. How much? 60,000. Okay, forward purchase cancelled 30,000. Okay, sorry. 30,000. Sorry. No cancel, no effect. Remitted by TT under spot remittance. Remittance. Remittance is a sell. 75,000. And here it's a debit. Draft on jurish cancelled. Normally DD is a sale for the person. So now it will become cancellation. DD cancel. Already sale is recorded now recorded as a buy. No effect. Okay. Total 50,000 plus 80, 130, 160. 90 plus 175, 165. So tell me, sold is 165, bought is 160. I have a oversold 5,000. Oversold 5,000. Okay. Next, credit balance is 1 lakh, debit balance is 75. Excess credit is 25,000. Okay, excess credit is 25,000. Okay, now answer my question. We oversold now. We wanted to square up our position exactly, but we oversold. How much extra sold? 5,000. Sir, if you have 1,60,000, how can you sell 1,65,000? Interbank I will buy and I will sell. What is so great? Already we discussed about that now. So oversold. We wanted to square up. Now you see what is happening. What is the target? What is the target? See, maintain a credit balance of 30,000 in Nostro. Okay, overbought position should be kept at 10,000. We got oversold, but we want overbought. But you want overbought. Always remember, whenever Nostro exchange position, first adjust Nostro account because it's a real cash transactions happen. So tell me, what we need to do? What we need to do? We want 30,000 in Nostro. We want 30,000 in Nostro as a credit balance. But we have only 25,000. What we need to do? We need to make it 30,000. Means what we have to do? Spot buy. How much spot buy? 5,000. Spot lo buy 5,000 Swiss francs. Now the required balance is reached. But try to understand whether it is spot buy, whether it is a forward buy, exchange position account will get affected. Oversold, negative 5,000. Now we made a spot buy. Double impact. Buy. So now balance is made as 0. But what is the required balance we want? 10,000 rupee. Overbought we want. What we have to do? Forward buy. Forward buy 10,000. Sir, why forward buy? Why not spot buy? If you spot buy now, again this will change. Therefore, forward means only exchange position will get affected. The cash position account will not get affected. So, forward by 10,000, spot by 5,000 we need to do. Forward by 10,000. Forward by 10,000. Spot by 5,000. Spot by 5,000. Answer over. That's it. Then it will become 165, 165. Here it will become 30,000, like that we will do. So, okay. This is how we need to do questions on exchange position account and cash position account being Nostro accounts. Okay. Let us do one bonus question also. See here. XYZ Bank Amsterdam wants to purchase 25 million, again rupees 25 million against pounds for funding their Nostro account, and they have created Loro account with the Bank of London in London. Calculate the amount of pounds created. Ongoing international bank rates are so and so for dollar and pound. Okay. Read the question first. Read the question. Please don't see answer. You have to try. Read the question. See here. What is the modus operandi of this question? See, there is a bank called as XYZ Bank. It is in Amsterdam. This particular XYZ Bank, their currency is not rupee, but for their Nostro rupee account, they want rupee. Now, did you understand that? They want rupee to fund their Nostro account. That's why they want $25 million, 25 million, under 2 crore 50 lakh, not even 25 lakh. 2 crore 50 lakh rupee they want for their Nostro account. Which Nostro? Indians will open Nostro account with other currencies other than rupee. Other countries will open also rupee Nostro because rupee is a foreign currency for them. So this Amsterdam bank wanted 25 million rupee in their Nostro credit. Nostro credit as per their management's request. Okay. And they have created Loro account of Bank of London. Why another bank came? XYZ Bank do not have a Nostro account with rupee with itself. So they are taking affiliation with another bank called as a Bank of London and opened a Loro account. Okay. Calculate. That doesn't have any impact on the question. Calculate amount of pounds credited. Amount of pounds credited. Ongoing interbank rates are so and so. First of all, I will ask you one question. You please answer. Okay. See, XYZ Bank is from which country? Amsterdam. Indian or not Indian bank? Not an Indian bank. That particular person wanted to buy what? Millions of rupee. 25 million rupee they want. Okay. For their Nostro. Now, directly they don't have Nostro account. So through Bank of London they are coming by opening a pound Nostro. By opening a Loro account. By opening a Loro account. Loro account they opened with rupee and they came. Now listen carefully to the point. Amsterdam currency is actually Dutch guilders, but Indians will not even they don't even know the name called as a Dutch guilder. They don't even buy, they don't even sell. Waste of time, unnecessarily putting stock of Dutch guilders with me. So pounds is okay. Therefore, what they have done is we will do one thing. We will not give our Dutch guilders. Through Bank of London, I will open a pound account and I will give you pounds for that rupee. Okay. Forgetting about all these things, in simple language, if I have to tell, XYZ Bank wanted to XYZ Bank, Amsterdam, wanted to purchase 25 million rupee from a international bank. Now listen carefully what happened. Our bank is SBI. or our bank is Canara Bank. In the international banking market. International banking market, how many banks are there? Indian related banks also will be there. But I am not a local participant. This Canara Bank is not our local Canara Bank. Forex dealer, international bank participant. Okay. Now we are the international bankers. Now listen carefully to the point. See, we wanted to sell rupee and they will sell us pounds, means we are buying the pounds. We are buying the pounds. Next one. He is asking, compute the amounts of pounds credited. Canara Bank Nostro account, how many pounds are credited? Because technically we are buying the pounds. We are buying the pounds. Buying means balance in credit will increase. That's why bank passbook is there now. If you receive money, what will happen? It will be credited. That's what he is asking. So pound should be created. How much pound should be created? Now you answer my question clearly. XYZ is a dealer, came to the Interbank. Interbank, we are the main king participants now. We are buying the pounds. We are buying the pounds. From pound point of view, you should tell the answer, because question they clearly said, calculate the amounts of pounds created. So from the pound point of view, tell me, we are buying pounds or selling pounds? Buying pounds. We are what bank? Interbank. So ours is the upper hand. So we are buying pounds. And Interbank is buying pounds. Customer is selling pounds. Customer is another bank. So we are buying. We will buy at what rate? Lower rate, because we are interbank participant now. We will buy at a lower rate. Lower rate means bid rate. Bid of rupee by pound. Bid of rupee by pound. But rupee by pound is not quoted directly. So bid of rupee by dollar into bid of dollar by pound. Tell me, what is the bid of rupee by dollar? 61.3625. Bid of dollar by pound given is dollar by pound. See, per dollar means a dollar by pound. Bid, how much? 1.5260. 61.3625 into 1.5260. 93.6392. 93.6392 means what? For every pound, we need to pay 93.6392. How many rupees you want? 2 crore 50 lakh. How many pounds will be created? 2 crore 50 lakhs divided by 93.6392. 266,982. Yes. Sir, you got 266,982, sir. We got 2,67,500. Reason is, clearly I am saying that reason is because of that rounding of impact. Okay. Reason is because of rounding of impact. See, in this question, we got 266,982 minus 267,500. 517 is the difference. In that millions, lakh, crores, not even millions. 2 crore 50 lakh, 517 change will come. Why the difference has come, sir? Because we have done question in this way. Sir, no, sir. Can you do in a reverse way? See, instead of doing from the pound point of view, do from the rupee point of view. Same question. Instead of saying we are buying pounds, let us say we are selling rupee. We are selling. That is also right now. So, we are selling rupee. We are selling rupee. Interbank is selling rupee. Others have to buy rupee. We sell at a higher rate. Higher rate is ask rate. Tell me now. Ask of. Now rupee point of view we are doing pound by rupee equal to ask of. Okay, ask of pound by dollar into ask of dollar by rupee. Okay, ask of pound by dollar. Given question is what? Dollar by pound. Idi dollar by pound. We want ask of dollar by pound by dollar. So 1 by bid of dollar by pound into ask of dollar by rupee. Given quotation is in rupee by dollar. So 1 by bid of 1 by bid of rupee by dollar. If you observe again, bid came again. Already we have done. So 1 by. So 1 by bid of dollar by rupee or dollar by pound. 1.5260 into 1 by bid of rupee by dollar. 3625. Okay, this all into 2 crore 50 lakh. So 2 crore 50 lakh divided by 1.526 divided by 61.3625. Again, we got how much? 2 crore 2,66,982. So then why sir institute has got that extra so small amount of excess? Why it came? See, 1.5260 into 1.61 divided by 61.3625. We have directly multiplied and does the answer. Nah, institute does not, the institute has done like this. 2 crore 50 lakh into, they have done 1 divided by 1.5260. 0.6553, rounding of impact came now. 0.6553 into next 1 divided by 61.3625, 0.0163, rounding off again. So 2 crore 50 lakh into 0.6553 into 0.0163. Now we got 2,67,500. Now we got the answer. That rounding of impact they have done. See, 1 by 1.15260, 1 by 1.5260, 1 by 61.3625, 1 by 61.3625. Then where is the chance of getting a wrong answer? Yeah, this is only because of rounding off. Am I clear? So this is how they have done. This is another question we have done on Nostro and Nostro account calculations. Okay. That's it. Yeah. Beyond this, you need not do anything. With this, we completed so many concepts inside one single area. Money market hedge over, bankers hedge over, bankers hedge like exchange position, cash position, all these are completed. Okay. Next part that I am going to start is, okay, Forex, cancellation, extensions and early honors. Once that is completed, Forex with capital budgeting, then we'll go to currency options and currency futures. Okay. So this is one part of the video. Another part also will come.